Ready? Good morning, everyone. Sorry we had a little bit of the delay. The delay was due to the rebooting of the network here at admin. We had some internet issue, so Quan was rebooting the whole system, so we had to delay it by half an hour. Thank you, managers and brokers, the rest of the leadership team that immediately posted on the social media and network. So you can view this either through Hub or through Remax hallmarklive.com or .ca, or also Teachable Moment. So this morning I'm going to talk about the GTA real estate market update. I'm not sure, because it's feeded through the YouTube channel. I'm not sure if some clients are also on this calls or no. So I introduce myself. My name is Steve Tabrizi. I'm the Chief Operating Officer with the Remax Hallmark Group of Company. So the clicker doesn't work. So Remax Hallmark Group of Companies is 35 offices in Ontario, 1,700 agents. We do have about 22,000 transactions we do in 2018 and 19. We do about 23, we do one transaction every 23 minutes, and the volume of our transaction has been $10 billion in 2019. So let's talk about the GTA. Why GTA? GTA has been the hub of the economic growth, immigration, and global investment for Canada. It's a 7th city out of the 140 most livable cities in the world, ranked in 2019. Average age in city of Toronto is 39. It's a very young and vibrant city. Larger contributor to the Canadian economy. Many people refer to Toronto as a New York of the US. City of Toronto, or GTA as a whole, is expected to increase its population by $2.8 million by 2041. We are currently at about 6.2, 6.5, the last estimate. So we should be out there close to about 10 million by 2041. Historical net migration for Ontario, as you can see on this graph. By the way, all these graphs and slides will be available in Remax Hallmark Hub, so you can access it. As you can see on this slide, between 2020 and 21, we were supposed to have the highest increase in the number of the immigrants coming to GTA, almost by about 250,000. The highest we ever had was sometimes around mid-80s to early 90s, and we were supposed to have a steady, flat growth of about 175,000 people anywhere between 2027 and 2041. Condition of the housing market before the shutdown or before COVID-19, we had in a decade of the 131% increase in prices, average roughly about double digit, about anywhere between 8 to 10% increase on an annual basis. We had a great rebound from the chaos of the 2017, which has basically landed us in 2019 with, again, double digit growth. Days on the market prior to COVID was 23 days. Average sale price for condo was about $712,000. An average price for the freehold was about $902, which was about 14.5% increase compared to the year before. In the first quarter of the 2020, we sold about 4,655 new condo, which was about 211% increase from the same period last year. So, condition of the housing market again continued before the shutting down. Pre-condo construction benchmark price was about $961,000, up about 21%. And the real estate market as a whole, it's been a great source of the GDP for GTA. One of the subprime lender just carrying about $25 billion worth of the mortgages. That's just the one subprime lender, which is not a part of even 5 banks. The stat shows about 14 new homes are under construction per 1,000 individual, and if anybody, based on the current price of the rent a property, it takes them about 21 years to pay the current market value of that property. Cap rate were dropping drastically, and the cap rate currently is sitting at about 3.5% in GTA. So, downshift in price per buildable square foot before the COVID-19. We noticed heavily that price per buildable square foot for the land dropped anywhere by about 10%. We notice mainly in downtown core, and we notice in 905 area. But even with the drop of the price buildable per square foot only represented about 10% of the actual finished product cost. Right now, basically the range of the price per buildable per square foot is anywhere from about $117 to about $154. And we notice in 2019, the cheapest price per buildable per square foot was about $68. Shift in the proposed height. Because of the delay in construction permit, majority of the developer, they shifted their development to medium density, anywhere between 8 to 12 story, because 8 to 12 story was a part of the secondary plan, and it was a faster for approval process. So Neo Housing, we only managed to complete roughly about 15,000 homes in 2019 compared to major demand that we had. And we are still short by about 50,000 new homes overall in GTA. So what happened in the first 3 months of the 2020 with all the challenges that we had? Pretty much in every subprime market, we had a growth. We had average growth of anywhere between about 3.5% to 6.5%. Richmond Hill had about 5.3% growth, and Pickering had about 5.4, Ajax had about 6.4. So we will have the chart available for you for your reference in the future. So what happened? Arrival of the COVID-19. March 17 was the state of the emergency in Ontario, and March 23rd was a shutdown. And we like to refer to it as a disruption. Anytime a disruption happens in any kind of business or any market, it creates three reactions. One is basically uncertainty, collapse, and the reaction from the public and the businesses that they run in the industry. So collapse, equity market, the stock market had a free fall, shutdown of the non-essential services, reduced work hours, shutdown of the Canadian borders that affected the flow of the immigrant, job losses, and in our industry, the two important issue was open houses was suspended, and also private showing to a bare minimum. So those are two important elements that reduce our engagement level with the public. So around the same time, Abacus Data did a survey within the Ontario and Toronto, and 79% of the people, that's a reaction that happened. The 79% of the people were aiming to hoard groceries, and if you recall, on the news, everything was about the toilet papers and the shortage of the toilet papers and pastas. Around the same time, with the same survey, everybody was under the same impression that 65% of the people, they think the worst is still to come, and 5% they believe the worst is behind us, and 29% not sure at this point. So definitely it created a reaction and uncertainty in the mind of the consumers. But Canadian, they really embraced the changes with the shutdown order, and as you can see in this graph, almost anywhere between 70 to 92% of all the elements of the social distancing, avoiding large crowd, avoiding leaving house, washing your hands more regularly, Canadian, they follow it. So that's really caused that we could be really ahead of the curve and ahead of the pandemic. So let's compare what happened COVID-19 to two major recent financial crises that we had. Let's actually compare them more precisely with respect to the real estate. In 2003, when the SARS happened, sales declined by 10%, but housing prices increased by 6%. SARS didn't have as much major effect of the shutdown as a COVID-19, so we have to keep that in mind. 2008 was the financial crisis, which started from the US. GTA sales were down by about 35%, home prices declined by almost about 13%, and GTA prices actually almost collapsed by about 25% in terms of from a $300,000 benchmark to from $377 to $300,000. But in January of the 2009 made a really strong V-shape rebound, and the prices were almost in January of the 2009 for roughly sitting at about $365,000. That really demonstrates the resiliency of our market. So when we go back to take a look at the COVID, this is a type of report that most of the regulatory of industry are presenting, and the media are taking advantage of these type of report. And if you pay attention to this type of report, you will see the average basically sales and average inventory has dropped by almost about 65%. And the media is portraying this picture that the market is down by almost about 65 to 70%. But that's not the reality of our market. And therefore, I really urge you not to pay attention only to two elements of the activity or number of the transaction, and also the number of the listing. So let's take a look at the perspective of the home ownership in Canada. Almost 40% of the Canadian, they are carrying a mortgage, 28% of the Canadian are free mortgage. So 68% of the Canadian, they, in what sense they have a pride of the home ownership. So home ownership has been big in Canada. And again, I have referred to this chart in the last few presentations. It's quite important to understand how important is the real estate industry for a Canadian market. Almost 15% of our GDP is related to the real estate market. Last year was the highest and fastest growing sectors of the GDP, $254 million. And if you add another $150 billion of the GDP, which is related to construction, is almost $400 billion of the GDP comes directly or indirectly from the real estate transaction. So during the COVID-19, the first step that the federal government did, dropped the interest rate. Interest rate dropped almost by 4 times faster than ever in the Canadian history, and basically the Canada prime rate is sitting almost at a quarter, very close to zero. Also, the government, but when they dropped the interest rate, one of the first reaction that they were expecting that the market react and the market would stabilize. But unfortunately, it did not. And the reason it did not, because the market is sort of a paralyzed. It was an artificial shutdown that we couldn't do or have any activities. So Canadian government, federally and provincially, stepped in, and so far 145 billion, which is almost about 8.4% of the total Canadian GDP, which is $2 trillion, has been allocated to some sort of the funding and stimulus for the packages. If you look at it on a global perspective, if you look at the Germany, if you look at the China, if you look at the Australia, and you can see Canada, it's really among the top 5 countries, and we shouldn't actually compare Canada to the US because the size of the country and the size of the population and the size of the GDP. So Canadian government, federally and provincially overall, has done a great job. All the measure that the Canadian government acted fast, and today is May 11. So state of the emergency happened on March 17. In less than 2 months, we are reopening our industries. We're reopening some sort of the businesses. I'm sure you have noticed from the May 4th to today, which is almost about 1 week, certain businesses are open, and this week will be another businesses going to be start to reopen. You got to keep in mind the real estate is being part of the essential, so we are legally allowed to operate and open. But what we are planning to do, making sure that we have all the precautionary measure in place before opening some of our offices gradually. So what we did, we tried to take a look at what has happened in the behavior of the house purchases in the last particularly 4 weeks in the month of April. This is the chart for the freehold homes, and the darker orange represent the month of April, and the lighter orange is represent the month of February. Why we picked the month of February and comparing it to the month of April? Because in February we really didn't have any intervention by the government, and the market was just going through its normal course. So we thought maybe we should compare February to the April. By this comparison, we notice in a freehold market, homes, detached, semi-townhouses, we notice any properties up to $1 million actually in April had a better performance than February. We noticed the upper market is actually not performing that it's supposed to perform. And it's really natural. Upper market are affluent individual that they are basically sitting in the higher category of the income and a higher category of the home prices, and they tend to sit on the sideline because there is no urgency for them either to sell or buy properties. We did the same thing with the condo market. We noticed the condo market up to the price category of the $600,000 is moving quite well, and as soon as the price goes anywhere between 6 to 800,000, it's almost at par, and then anything above that, the activity hasn't dropped drastically. If you, for example, pay attention anywhere between $800,000 to $1 million, we notice the activity from 9% dropped to the 7%. And there is activity really, it's happening in all segments of the price category, but the synergy of these activities are different. So we also take a look at the first-time home buyers, because we were very concerned when we come back out of this pandemic, what's going to happen with the largest sector of our home buyer. Those are millennial, those are home buyers that they have a great job. So if you take a look at the percentage of the first-time home buyer prior to pre-COVID, anywhere in the range of the 25 to 34 years was about 64%. And we wanted to correlate the first-time home buyer with the job losses and employment. And we take a look at also the job losses that was just announced by Stats Canada. And yes, everybody thinks that we lost about 2 million jobs, but the reality is most of those job losses are temporary, and as you can see, the businesses are reopening. Now they are re-engaging and rehiring back their employers. For the first-time buyer, we noticed one of the smallest segment of the job loss. They were the same group of the 25 to 44 years old. Sometimes something anywhere about minus 77,000 loss of the job to about $100,000 job. So if you take a look at the perspective of even 2 million loss of the job, it's almost about 5%. So the first-time buyer, mostly due the millennial of having a professional job in either public services or professional services, their loss of job has been minimal. So now we are almost 2 months through this pandemic. The same company, Abacus Data, did another survey and asking the question how the Canadians are perceiving the reopening and the decision of the provincial government. 83% of the Canadians are confident that the opening should happen, but they like the opening happen step by step and stage by step. And that's what we like to see it too. Nobody really wants to jumping back to the normal the way it was before. Only 17% they said, oh, it's time to open up and let's loosen up all the things that is happening in our industry. So same thing about the reopening of the economy. So ask the people how many people are willing to go to the shopping mall. And if you recall the first surveys, almost 65% of the Canadians, they said, I don't want to have nothing to go out, I'd just rather to stay home. Here on this report, you see only about 26% of the Canadians, they said, yes, they don't mind to go to the shopping mall, but 66% of the Canadians, they said, as long as the shops and the stores and restaurants, they have the proper procedure in place, they don't mind going there. So again, the confidence level is building up, and as we discussed maybe in some of our previous presentation, this is a psychological crisis more than financial crisis. Reopening of the offices, which relate to our business, is actually better stats. 71% they said they feel comfortable to go back to work. And we learned through this pandemic that we can work from home, we can work virtually, we can work through use of technology. Only 17% of the public that they really work in the offices, they don't feel comfortable. So looking at the stats, looking at the transactions that are happening, looking at the activities that are happening, looking at the review that we receive from the public perception and the survey that we have done, we do believe, and even the report from the TD Bank that I'm sharing here, it shows that we are still in a seller market. Yes, we had a drop from the second week of the March to the end of the week of the March, and then we basically went all the way up. And now in month of April, we are in a good shape, and we are not even in a balanced market. We are still in a seller market. In some area, in upper end homes, we are in the balanced market. We are not still in a buyer market. So We decided to do a Remax Hallmark analysis of the areas and the region that we practice. So the first area, we take a look at the 4 parameter. One was the ratio of the new listing to the sales transactions, so which is referred to as SNLR. So Hallmark versus the market downtown. The downtown, this is basically the area that most of the condo market is happening. And what we did, we compared the last 2 weeks of that, the first week of the May and the last week of April. We compared them to the last 2 weeks of March. We noticed the Hallmark, which is the red bar, is performing at a 48% ratio versus the industry or the market performing at a 42%. Average days on the market for Hallmark listing has been 9.3 days. Average days on the market for the rest of the other companies or the market has been 14.2%. The other 2 elements that we look at the downtown was average sold price. Average sold price for the Hallmark was 860 and the average sold price for the industry was 830. Sold to listing ratio, basically it means what percentage of the price that we got for our listing. We got almost 104% over asking, 4% over asking, 104% versus 99.8% for the industry. That's for downtown market that is performing. So we went from the downtown market to the central, north central market, and the north central market, the SNLR was 62% versus 55%. The days on the market, as you can see, is a little bit higher because that area, it's more above the $1.5 million price range, 13.2 days, and the rest of the markets was almost about 16 days. The average sold price was about 1.5 million versus 1,030,000, and the sold to listing ratio 102 to versus 99. Now we went also to take a look at the Beach and Riverdale, which is our PAPE office, which is our Leslieville office, which is our Beach office is there. So the SNLR ratio was 85 versus 61. We saw a huge performance here with our realtor over there, and days on the market, as you can see, 6.5 for our listing versus 9.5 for the rest of the market. So average sold price for us, obviously we are maybe more active on the softer spot of the listing, so 1.25 million versus 1.16 million for the market. And our listing sold ratio 110, and even if you look at the market is actually performing here better than compared to the other 2 areas. The market is at 107.62. So let's take a look at now we are moving towards the York region. Richmond Hill, SNLR was 47 versus 46, and days on the market almost 11 versus 15, and the average sold price in Richmond Hill for us was less than the market. We were about $1,010,000 and the market was about $1,020,000. And the sold to listing ratio for us was about 1.4 versus 1.2. You gotta understand, collecting the data is a very tedious task, and we did this from a sample pool of over 1,000 listing within the GTA. To do the comparison analysis. For Aurora, the new listing ratio was 64 versus 48, and the days on the market, as you can see in Aurora, for us was high. Aurora is a very affluent market, is a very high income neighborhood, and as you can see, the tendency of the consumers of holding to their list price is a lot higher. That's why you see days on the market for us has been 16 days versus the market 15.2, and very close. And unfortunately, the stats that we pulled, the information from the TREB, as much as we dissect them, as much as we analyze them, you know, some of the relisting properties, it will skew the days on the market. So average sold price for us was about $1 million, and for market was about $1,020,000, and the ratio for sold to the listing 104 versus 102. So now we move to the east. This is one of the areas that really performed quite well, and the reason is performed quite well because of the soft spot and average prices that did exist over there. So the ratio of the new listing versus the prices is 61%, and for the market it was about 58. The average days on the market is about 11 versus the market is about 15. And the average sold price, as you can see, this is the softest spot, 691 versus 640. And the sold to the listing ratio is 101 to 108. So what we saw overall for the last 2 weeks, last week of April and first week of May, we noticed the days on the market is increasing a little bit high. We noticed the prices across the GTA are resilient or holding. We noticed the area that they have a much more better affordability ratio, such as Durham, such as the condo market downtown Toronto, below 600 range. They are moving and it's still happening. We notice also an area such as Riverdale, when the prices are anywhere between about 800 to about $1.2 million, they are also moving fast. And we did the final analysis of the Hallmark listing or Hallmark buying side versus the market. So Hallmark listing by 21.65% more likely to sell in a listing period. What does that mean? It means that if it takes 10 days to sell a listing, we actually beat the market by almost 25% of the time. Average Hallmark sold price is 108% versus the market. If you really subtract the actual number, that it brings me to the next line, which shows the Hallmark listing are selling for 3.5% of the more than the market value. So if you take the average price in the GTA, let's say is $800,000, it's almost 30 grand more net profit in the seller's pocket. Hallmark sold 25.31% faster than the market. We talk about that. Hallmark also sold almost 4 days faster than the average market. So 2 elements in any product selling is important: the net result and the time, which is basically the efficiency of the Hallmark agent. And how we manage to do this is very important, how we manage to do this. Hallmark has 5 reasons that is outperforming the market. Clear purpose. Our purpose has always been our realtor should be the best in the market, therefore we can serve their clients. Core competence and vision. We were ahead of the pandemic. We started our shift and pivot almost about 5 years ago by centralizing, by expansion, by creating the referral base, by creating our training and development center, and by adopting innovation to technology. So we are years of the competition, ahead of the competition, and that was the reason that we could adapt to the changes immediately more than anybody else. And the market share and the expansion that we have, it really speaks volume about the power of the RE/MAX Hallmarks in any market that we perform. So, economy recovery. The economy of the recovery is going to be reaching through. Panic is never a good strategy. Some people overreacted. Some people now are really sitting on the sideline and wondering what's going to happen. Therefore, those individuals, they need really highly communicative strategy and educating them. Historical data is a good predictor for the future event. We just proved to you that historical data is showing really that the market, yes, the market dropped in March by almost 70% in activity, but the market right now is performing at the ratio of about 55 to about 65, depending on which area. Strong flow of the immigration, it's going to happen as soon as the airports opens up, as soon as the travel restrictions are lifted. Air Canada was announcing last time they have a very strict protocol in terms of taking their flights and going through the airport procedure. It will allow those backup, pent-up application that they are sitting and waiting for arrival in Canada to start flowing into the Canada. Net job growth. Yes, we lost job in the hospitality. Yes, we're going to lose some job in the retail, and it takes probably about 12 to 18 months to come back. But we're also creating some job in finance and technology, because many companies are adopting into a style of the workplace till perhaps the vaccine is discovered, because we need to create that physical distancing. Some of the staff, they will work from home. Some of the staff, they will work from the office. Canada's low currency, as much as we don't like to talk about the low currency, but it will attract the foreign buyers. Low interest rate, it will be around minimum for another 18 months. I predict probably till end of the 2021, we will have the low interest rate. Decline in the rental rates in the short term. Prior to the COVID-19, the Airbnb announcement happened. And now, because of the lower appetite for the investment towards the condominium market or investing there, we will see a bigger pool of the rental, which will push the rental market down, which frankly overall is a good sign for everybody, because the whole argument of the industry is always has been the affordability, supply and demand. Investor, they probably will shift more towards the freehold, more towards the suburb. Liquidity injection, there is enough money out there. We talk about 145 billion stimulus package that the federal government has announced. The wage subsidy, it was supposed to be 3 months. Mr. Trudeau announced just last week that basically he will extend it. Urban center, where we just talk, the more cosmopolitan area, they will be much more stronger than a smaller rural area. So therefore, Durham, Barrie, York Region, Toronto, Ottawa, these are all urban center. They will really perform well. Overall, the province will lose job in this quarter and may actually lose some job also the next quarter, which is basically 2020. We shouldn't pay attention that we were expecting to do 95 transactions through the TREB stats. Yes, this year we're probably going to do land around 70, 75. It all depends how we reopen and how the state of the mind of the consumer be towards the recovery of the market. The economic recovery at the moment is a check mark, is a sharp drop and now gradually coming up, but at one point probably in fall will be a V shape and will go back up strongly. So we talk about the vacancy projection. Basically last year also the provincial government announced for the purpose built rental, which is almost about 14,000 units are right now under the construction. That will add to the pool of the inventory. Right now the vacancy rate is sitting at about 2.1. We predict probably it will go as high as about 4%, which is still low. So there will be a competitiveness in the rental market. We expect the rental market prices will drop by average about anywhere between 8 to 10%. Temporary setback, and then you will see it will be normal recourse and will come back. And the actual healthy rebound probably will be the first quarter of the 2021. So we will be at the 100% of performance similar to the February of the 2020. So this is a quote that I leave you from Warren Buffett. Fearful when others are greedy and greedy when others are fearful. This is the time of opportunity for many buyers. This is the time of also opportunity for many sellers. I have said this multiple times. You buy low, you sell low. You sell high, you buy high. So, but there are opportunities out there. There are opportunities within the condo market. There are opportunities with the suburban market. There are opportunities with the investment market. And commercial industry perhaps is going to suffer for a while because many of the tenants that they are right now within the commercial portfolio, that they will have a difficulty to pay their rents, and they need assistance from the investor, which are those owners of the commercial properties. All the slide deck will be available at the hub. I'm here to answer all your questions. There are many people helped me to do this presentation. I have 3 researchers that they did the research for me. I call them my researcher, Michael McLaughlin, John Kim, and Sam Gani. They helped me through all the region, pulling the stats and brainstorming the idea. My technical team, Shant and Kwan, they help, and the rest of the leadership team. So our apology for half an hour delay, but that's what happened. This is called technology, and everybody is really embracing this new technology. We love it. I'm here to answer your questions, so I think Shant will read some of the question. If there is any question, I'll be more than happy to answer. Any question? How many people? How many people? I guess no question. Probably I went too fast. No, I did on my time. 12:05, half an hour.
I was waiting for him to type because he said we'll be able to ask questions. They'll misunderstand that builder's costs seem very low.
So Glenn Ford asked about the builder cost. Talking about the builder cost seems too low. That's the builder cost price buildable per square foot. I'll give you an example. So if the price of a land, when we refer to that chart, maybe I'll go back to that chart so you will see the chart. If you give me 1 second. It is shortly going to be here. So this is the builder chart, as you can see, okay? Average price per buildable per square foot. So if you take a look at it from the Q2 of the 2018 to the Q4 of 2019, it is dropping. It is dropping both in a 416 and a 905 area. But this price only represents the 10% of the actual finished product. Give you an example. If the finished product of a condo is selling for about $1,100 per square foot, if you take a look at the Q4 of 2019 in 416 area, is only $117, okay? And then on the top of that, you add almost about $350 the construction cost, you add about $100 soft cost, and you add another $100 of the cost for taxes and marketing and commission. So an average cost for a condo in a 416 area depend on the type of the land. If you're taking a look at about that $117, it's about $750. Therefore, that's why they are aiming for $1,000 to $1,200 to sell it. That's why you see most investor, most builder, they are shifting towards the low density, lower floor product, and they're shifting towards the suburb because the price of the lands, as you can see in the 905 area, the same land in the last Q4 of the quarter of the 2019 is $68 versus $117. So, and the ratio of the drop, and you can see for a 905 is only been drop of the 7%, for the 416 has been drop of the 11%. I hope I answered that question.
We have a question from Ari Zadigan. How much of a drop do you expect on commercial retail office building?
Ari, that's a very good question. It's all depend. Office, let's talk about the office. The office is all depend how fast we can re-engage everybody, go back to the same building and the same premises. Obviously, nobody, from my information that I have, the big corporation, they are freezing all the leasehold improvement. So they are going to probably work on the stagger shift, meaning morning and afternoon, and some people work from home. You won't see a major change right now in the office building in terms of relocation of the head offices to a cheaper area or shrinking, downsizing, because based on the federal stimulus package for a commercial rent, 55% is to certain months, is supposed to be announced. It's not out there yet. It's supposed to be supported by the federal government, 25% by the landlord and 25% for the tenant pays. But it's subject to different type of business. They take a look at your cash flow. They take a look at if your business actually dropped by 80% in terms of the income. It's not just a blanket check that they give it to everybody. I would see the effect of that in about 12 months from now. Why? Because definitely businesses, they're going to be different coming out of this COVID-19. It has proven to us, best example is real estate. Human interaction and its necessity for all other businesses. Doesn't matter, real estate, retail, hospitality, going to the mall and everything. But do we need larger space? Can we embrace the technology? If so far every business embraced the technology only, let's call it email, PDF, even from the big corporations such as banks, they still want the clients go to the branch, sign the paper. They won't do the paper signature through the PDF because they want the original signature. Lawyers, you name it. I will see a big shift because if the bank, they look at the cost saving for them, reducing their brick and mortar and basically embrace the technology, frankly, it will reduce the cost. Secondly, also the efficiency and customer service will go through the roof. We take a look at our help desk here. Our help desk is going to be, has been amazing, and we are planning to expanding our help desk because it's a controlled environment. We can see our staff, we can monitor them, we can make sure that they do the job that they are supposed to do. and they provide the four-season service, and there will be less distraction for them.
Next question from Kayvan Zabarjadian. He goes, what is your suggestion for renters who want to buy? Should they wait or should they buy?
The renters, Kevin, if you're buying for a long term, renter is the first phase of any home purchase. From renting cycle goes to the ownership. That means they're going to be in that home minimum anywhere between about 3 to 7 years. Let's call it 5 years. I would buy because right now is actually that renter has a tremendous opportunity to negotiate. That's another thing that we noticed when we went through all of our areas in terms of the actual market. When we take a look at why the sales to listing ratio for the market was anywhere between 98 to 101, because now those buyers have the ability to negotiate the price rather than being in a February in a multiple offer. So I would definitely go buy. And there is a tremendous opportunity for them also in a soft market, Durham and Barrie. Keep in mind, if they don't buy right now, those soft markets, because they're going to be probably 60% of the growth for 2020 and the first half of 2021, their prices will start going up. So don't miss the window. The window right now for you, frankly, is this month and maybe till end of the June.
Next question comes from Yaya Dardashti. Do you think clients should still buy pre-construction or from resale?
Yeah, it's a very good question. This morning at the incorporation Zoom, Ari was mentioning that we see behind the scene, which I've seen it too, we see behind the scene that developers are coming with a very aggressive offers, delaying the payments, lowering the down payment. I would basically review that as a case by case, because the investor, if it's a long-term investor, yeah, if you can buy a property with the tenant already in and you don't have to worry about all the issues around the pre-construction, I will buy that because it's a long term. I know exactly my cash flow. Everything is about the cash flow. For investor, it's always been my advice. You make sure you will have minimum 6 months cash flow if in case your unit is empty. Okay? So pre-construction, if there are phenomenal deal out there with the lower down payment, longer payment schedule, I would definitely consider those things. Because keep in mind, the downtown Toronto, which is the really hot spot for a condo, let's call it, I wouldn't even call it downtown Toronto, I would call it probably south of Eglinton. Those areas always going to be hot. People really want to be in those areas because it's closer to transportation, close to the hub, close to the businesses, close to the towers.
Next question comes from Susan Togluyan. When do you expect real estate business to rebound to levels pre-COVID?
Gradual. So take a look at it. End of the March, we were down by about 70%, call it activity. Now we are down only by about 45. So we are up by almost 25%. So I would see by September, we will be maybe down only by 20 to 25% if we continue going the same way. I'll give you one of the best example was just this morning. We take a look at the sample size. It wasn't part of my slide. We took a sample size of our appointment and a front desk for the last week, including all the region with the exception of the Ottawa. In mid-March, the front desk had approximately almost about 4,500 activities on, let's say, the best week, the average of the month of March. We are now almost at about 2,600 activities. We are above 50%. A week ago, we were almost only about 1,700. Everything is green, everything is up. If we continue the same single-digit growth, Susan, we should see 70-75% by end of August before the schools open. And I predict that basically our best month, which was supposed to be May, June, and July, it will be, our summer is now going to be fall. The fall market always had played about 30% of the whole market, and these 3 months, May, June, July, played almost 60% of the market. Now it's going to be reversed. Probably we will have more momentum in fall than what we had in the summer.
Next question from Mary Bateman. Do you think that foreign buyers may drop out of new builds that are finishing in the summer or fall?
No. foreign buyers, they have one power that the Canadian they don't have: exchange rate. Exchange rate is sitting in their favor big time. I'm talking about 1.35. So one US dollar will take you $100.35 Canadian. So 35% ahead of the game. So a $500,000 condo, it's actually costing them about 380 US. And they don't have this perception or the notion of, oh, Canadian dollar or any other currency. They always lived their entire life through the US dollars. So no, foreign buyers, in fact, maybe they don't enter only pre-construction. They will look at tremendous opportunities that's happening in a commercial market, and they will scoop probably a huge chunk of the commercial market because they started already doing that in 2019. Now it gives them a better opportunity to do it again. And the term of the commercial transaction are now in favor. It used to be no VTB from the sellers, because most of these lands, most of these big parcel of the development are owned by families for generation. They have no other alternative right now because the banks, they will be really tough on that sector in terms of the lending. The bank is now shift more towards the actual end user rather than investors, and there will be favorable terms by the sellers in terms of the VTB. So imagine this. We know last week there was a transaction happen in a Remax Hallmark. The vendor gave 3 years VTB at 3% interest, 4% interest. So you can't get that from the bank. So be creative with your investor group and make sure that you basically negotiate really good terms in terms of the financing from the sellers.
Next question from Mohammed Khorasanizadeh. What do you think of residential market appreciation in 2020?
We talk about it, Mo. So if the prices are resilient, I see in some sector probably the prices will drop for a short period of the time, anywhere between about maybe 5 or 6%. Upper end homes, anything above $2.5 million home. They might have some drop in that range, but usually the upper end homes, the affluent clientele, they don't even move, so they don't really play a big part of the market. The rest of the market, the worst case scenario will be flat, identical to what it was 2019. You got to keep in mind the first 6 months of the 2019, we were just coming off the chaos of the 2017 and 18, so we were just actually coming back to the prices that we had in 2017. Second half of 2019, we had about 5 or 6% growth and then become double digit at the early of this year. So major drop won't be that much. It will be flat, but some sector, there will be a price drop, anywhere from a 5 to 10%. It won't be a double digit.
Next question from Patrick Gillis. Regarding rental market in the GTA, specifically Toronto, what is causing the average rent to drop? Was it the Airbnb overloading the market or something else?
Airbnb is one, Patrick, is one of the concern. The concern is the most renter, they are on the low income family income bracket, most of them. That's why they didn't have the ability to buy. So job losses impact them more than anybody else. That's the second reason. Third reason, there are also a group of people that they said, you know what, I'd rather rent than buy and I have a good income. Now, what we call them smart renters, they see the competitive edge that they have against the landlord in the market. If the inventory increases and in the same building, now there are 6 units empty and the price is less than what they are paying. The smart one, they will basically talk to the landlord and just say, either be competitive or I'm moving to the next unit. And most of them, they will move probably within the same building. So 3 reasons: Airbnb, job losses, and increase of the inventory, which give the tenant the competitive edge.
Next question comes from Jeffrey Grace. Steve, what does the outlook look like for commercial retail storefront leasing?
It's going to be the worst sector. It's going to be the worst sector. Small businesses, small corporation, people who basically created business to have a job, small restaurant, small retail, more the street front stores that will be impacted rather than malls. Malls, they probably have an engine behind them through marketing, through advertising, deeper pocket for landlord. Those portfolios are owned by mega companies such as Ulmer, such as Oxford and RioCan. They will come with the incentive program to make sure that the tenants, they survive. And most of their tenants are large scale tenant franchisee or corporate store. But the street front stores, they will suffer. And it's all also depend how their landlord play with those tenants. You will see a higher rate of the vacancy. You will see higher inventory of those street front location, which is a store plus apartment, because maybe the landlord is just a small landlord and has one product, one portfolio, and can afford to basically carry the mortgage. And you see drop in the rent. There will be also, this is the opportunity. So if you have clients that, for example, owns a restaurant, own a retail, this is the opportunity. Go back to the table of the negotiation with the landlord and renegotiate the rent at least for a short period of the time. I'm not talking about 2 months or 3 months. I'm talking about going back to the landlord and just say, let's talk about if I have a 5 years or 10 years lease left, I like to actually have not a relief. I like to have a reduce on my base rent for the next 2 years, because those businesses, it will take them easy about a year to 2 years to rebound to the normal level. You got to remember the profit margin for those businesses was very small, anywhere from about 12 to 18%. So yes, you will see more for lease sign on the street. And also it will create opportunities for the developer. Some developer, they might pick those parcel of the properties, assemble them at the lower price too.
So for a final question from Anna Narasimhan, should a condo seller below 600,000 in Richmond Hill sell now or wait till fall?
They are on a safer spot, Anna. They are basically in the spot that is in high demand right now, hasn't really affected them. Their April stat shows in that area also they are doing good. If they are below 600 and if the inventory in the building is not high, I will bring them on the market and sell. We got to remember one problem that we have right now in our industry. So this is what, unfortunately, the regulatory boards are not emphasizing. They talk about 70%, 68% activity drop in a report for month of April, but they don't talk about the number of the listing. If the number of listing on the same percentage is low, so the activity is low. We need to always focus on our number of the transaction versus the number of the actual listing that we have. Okay, so if you see no competition in that building, bring the product on the market. We need, guys, listings, because we have enough buyers out there. The demand is there. But also be aware, when the market start to reopen, at one point, probably sometimes in mid-August, you will see a flow of a lot of new listing. Similar to when you guys were prepping yourself for a spring market, when the COVID happened, you were supposed to bring a lot of your listing, as I recall, sometimes between end of the March to first week of April. The weather gets better and everything. The weather is not really that great, even in the month of May. So it's going to happen in August. Watch the market, watch your neighborhood, and if you have a tremendous amount of the buyer, don't flood the market. That's my advice to you to also flood the market gradually, because we need to make sure that the buyer also absorb the understanding of the reopening and re-engagement. And that's why the survey, 83% of the Canadian, they said they love the reopening of the market, going back to work, but they want to do it gradually. That's what we're going to do also. We're going to reopen our offices in 3 phases too. So bring it back on the market if there is a low inventory. No other question. Thank you very much. Wednesday will be my market update for Barrie and Simcoe County. And tomorrow I'm interviewing Ken McLaughlin and Walter Schneider. The topic of this interview is how they survive 40 years of crisis. And I think it's very important that you tune in and listen to this interview, because if both of them, they have survived 40 years of the crisis, worse than what we have right now, it would be interesting to how to apply to each of you, your individual businesses. Tomorrow at 11, take a look at the networking group and you will see all the proper links over there. Have a wonderful day.